Most countries you hear about are deep in debt, rich ones, poor ones, allies, and rivals alike. The numbers are so big they barely feel real, trillions here, trillions there. And yet the global economy keeps running. Markets open every morning. Salaries get paid. So the first question is simple and uncomfortable. If everyone owes money, who exactly owns it? Here is the stranger part. Much of that debt is owed internally, governments owing their own citizens, banks, and institutions. Debt is not just tolerated in this system, it is actively produced and carefully managed. What looks like a warning sign is often treated as a stabilizer, even a tool of control. To understand modern power, growth, and crisis, you have to understand why debt is everywhere. Welcome to Global Insight. So here is the central question hiding behind those massive numbers. If debt is supposed to mean trouble, why do the strongest countries carry the most of it? Why do governments keep borrowing instead of paying it all back and starting fresh? And why do markets panic when debt stops growing, not when it grows faster? These questions point to a paradox at the heart of the modern economy. By the end of this video, you will understand why debt is designed to circulate, not disappear. You will see how countries often owe money to their own systems, not to some distant enemy. You will understand why this structure supports stability, growth, and political control at the same time. And you will be able to separate real risk from headlines built on fear. Once you see the logic, the system starts to look less broken and more intentional. The roots of this system go back to a time when governments needed money fast and taxes were too slow. Wars were expensive, unpredictable, and urgent. Rulers discovered they could borrow from merchants and promise repayment later. Those promises became formal agreements, written down and tradable. This was the early birth of government debt. Over time, these promises evolved into government bonds. Instead of one lender, many people could lend small amounts. This spread risk and made borrowing easier. Debt became something that could be bought, sold, and inherited. States learned that credibility was more powerful than gold. In the 19th and early 20th centuries, debt became tied to national growth. Railways, ports, and factories were often funded through borrowing. Countries realized they could build the future before fully paying for it. As long as the economy expanded, the debt felt manageable. Borrowing stopped being an emergency tool and became a planning tool. The system changed again after the World Wars. Governments had borrowed on a scale never seen before. To stabilize currencies, nations linked money to gold. But this limited how much they could respond to crises. Growth was constrained by how much gold sat in vaults. That link broke in the 20th century when major economies abandoned the gold standard. Money was no longer backed by a physical object. Instead, it was backed by trust in governments and institutions. This allowed countries to borrow and spend more flexibly. Debt became easier to create and easier to roll over. After World War II, a new global order took shape. Institutions were created to manage currencies, trade, and lending. The goal was stability, not zero debt. Borrowing was seen as a way to smooth shocks and avoid collapse. Debt was built into the architecture from the start. Central banks became the quiet managers of this system. They guided interest rates and influenced how much money flowed. Governments issued debt knowing someone would help manage demand for it. This reduced panic and encouraged long-term planning. Debt started to feel normal, even necessary. By the late 20th century, debt was no longer a sign of weakness. It was a signal of participation in the global system. Strong institutions mattered more than balanced books. Countries that could borrow easily were seen as stable. The meaning of debt had fundamentally changed. Start with the basic situation. A government wants to spend more than it collects in taxes. That gap can be temporary, like a recession, a disaster, or a sudden war. Or it can be structural, like pensions, healthcare, and long-term projects. The government has two broad choices: cut spending or find funding. In modern economies, the usual answer is to borrow. Borrowing happens through bonds, which are basically "I owe us" with clear rules. The government sells a bond and promises to pay interest along the way. At a set date, it promises to return the original amount. If you buy a 10-year bond for $1,000, you expect that $1,000 back in 10 years. And you expect regular interest payments until then. Who buys these bonds? Often it starts at home. Banks buy them because they are considered low risk and easy to trade. Pension funds buy them because they need steady, predictable income. Insurance companies buy them for the same reason. Regular citizens can buy them too, directly or through funds. So when people ask, who owns the debt? A big part of the answer is, we do. A country's debt is often held by its own institutions and citizens. That means the interest paid on the debt often stays inside the country. It moves from the government to investors, from taxes to pensions, from budgets to savings. It is not always money flowing out, it is often money circulating within. Now add the central bank, because this is where the system becomes uniquely modern. Central banks manage interest rates, which influence how expensive borrowing is. When rates are low, governments can borrow more cheaply. When rates rise, borrowing costs go up and budgets tighten. This is one of the main levers that shapes the entire debt system. In some periods, central banks also buy government bonds themselves. This is often done to stabilize markets during stress. When a central bank buys bonds, it pushes prices up and yields down. That lowers borrowing costs and calms investors who fear a sudden crash. Think of it like adding extra shock absorbers to a car on a rough road. This is also why countries can owe money to themselves in a very real sense. If the central bank holds a large share of government bonds, the government is paying interest into its own public system. Different branches of the state hold claims on each other, and the payments can be recycled. It still matters because the accounting is real and inflation risks are real. But it changes the simple story that debt always means dependence on outsiders. Another key piece is rolling over debt instead of paying it off like a household loan. When a bond matures, governments usually pay it by issuing a new bond. They return the old investor's money, then take money from a new investor. This can continue for decades as long as trust remains and the economy can support it. Debt becomes a permanent feature, not a short-term mistake. Here's a concrete example that avoids the big scary numbers. Imagine a government has a bond maturing worth $1 billion. It does not need $1 billion in cash sitting in a drawer. It issues a new $1 billion bond, sells it, and uses that money to repay the old bond. The debt did not vanish, it simply changed hands and got a new date. So why do investors keep buying? Because the system rewards them for it. Bonds are used as safe assets, as collateral, and as a parking place for large pools of money. Big financial players need something liquid and reliable, and government bonds often fit that role. In many countries, banks are encouraged or required to hold them. This creates steady demand and keeps the machine running. Finally, zoom out to the global layer, because some debt does flow across borders. Foreign investors buy bonds when they trust a country's stability and currency. Countries also hold each other's bonds as reserves, especially in major currencies. This is where leverage and politics can appear, but it is only part of the picture. The larger story is still domestic, built on institutions, trust, and the need for safe assets. Leverage in this system does not belong to a single actor. It is shared, layered, and often indirect. Governments have power because they set laws, taxes, and spending priorities. But their choices are shaped by how markets react to debt decisions. Confidence can be supportive or it can quietly apply pressure. Central banks hold a different kind of leverage. They control interest rates and influence liquidity across the economy. A small rate change can shift borrowing costs for governments, businesses, and households. They are expected to act independently, but their actions have political consequences. Their credibility is one of the most valuable assets in the system. Financial institutions sit at key pressure points. Banks, funds, and insurers decide where large pools of money go. They respond to risk, regulation, and expected returns. If rules or expectations change, their behavior shifts quickly. That movement can amplify calm or accelerate stress. Investors also hold leverage, but it is usually collective, not personal. One investor selling does little. Many selling at once changes everything. This is why narratives and expectations matter so much. Perceived stability keeps demand steady even with high debt. Perceived instability can raise costs without any new borrowing. International institutions add another layer. They provide funding, coordination, and sometimes conditions. Their leverage appears most clearly during crises or transitions. Support often comes with expectations about policy and reform. This influence is strongest where domestic options are limited. Finally, there is political leverage at home. Voters care about inflation, jobs, and public services. Debt decisions affect all three, even if indirectly. Leaders balance market trust against public pressure. That tension quietly shapes how far the system can be pushed. When this system breaks, it usually does not explode overnight. It bends first, showing stress through higher interest rates and currency pressure. Investors ask for more compensation to hold government debt. Budgets tighten as borrowing becomes more expensive. The warning signs appear long before any formal crisis. One clear example is Greece after the global financial crisis. For years, borrowing was cheap and markets assumed support would exist. When trust cracked, borrowing costs surged in a matter of months. The country lost market access and had to seek external assistance. The damage came from lost confidence, not from debt alone. Another case is Argentina, which has faced repeated debt crises. In its case, weak institutions and inflation undermined trust again and again. Debt became harder to roll over as the currency lost credibility. Each reset hurt savings, wages, and long-term planning. The pattern shows how fragile the system becomes without trust. Sometimes the break is contained and quickly repaired. In 2022, the United Kingdom saw turmoil in its bond market. A sudden policy shift spooked investors and pushed yields higher. The central bank stepped in to stabilize the market. Confidence returned once the policy direction became clearer. What these cases have in common is not the size of the debt. It is the loss of belief that the system will be managed predictably. When that belief weakens, costs rise fast. When it is restored, markets often calm just as quickly. The system is sensitive but not automatically doomed. So when people ask what happens if it breaks, the answer is measured. Life becomes more constrained, choices narrow, and margins disappear. Governments lose flexibility and households feel the adjustment. But history shows that repair is possible under the right conditions. Breakdown is not the default outcome, mismanagement is. This system matters now because its effects show up in everyday life, even when debt feels abstract. Interest rates influence mortgage payments, rent, and the cost of credit cards. Government borrowing shapes how much support exists during downturns. When financing is cheap, states can cushion shocks more easily. When it tightens, the adjustment reaches households faster. Debt quietly sets the boundaries of comfort and pressure. Jobs are tied to this structure more than most people realize. Public investment supports construction, energy, technology, and healthcare. Private companies respond to interest rates when deciding to expand or pause hiring. Stable debt markets encourage long-term planning instead of short-term survival. Sudden stress pushes firms to cut first and explain later. Employment follows confidence as much as productivity. Prices are another place where the system becomes visible. When governments and central banks misjudge balance, inflation can rise. When they overcorrect, demand can weaken and growth slows. Every grocery receipt reflects these trade-offs indirectly. The goal is not perfection, but predictability. People plan their lives around stable expectations. The future is shaped by how well this balance is managed today. Debt can fund education, infrastructure, and resilience. It can also delay hard choices if misused. What matters is not eliminating debt, but aligning it with real growth. This determines whether the next generation inherits options or constraints. The system touches tomorrow long before tomorrow arrives. Debt feels like a warning sign, but in the modern world, it is also a design choice. It connects governments, institutions, and citizens in ways that are easy to ignore and hard to escape. Understanding this system does not make it harmless, but it makes it visible. And visibility is the first step toward better decisions, public and personal. If you're looking for clear, in-depth analysis of economics and geopolitics, subscribe to Global Insight, Beyond the Headlines.